Mark Yusko was recently interviewed on the Paul Barron Network. In this short clip, Mark discusses the possible timing of a spot Bitcoin ETF and his thoughts on how much that will impact Bitcoin's price. The bottom line is that between the halving and the coming ETF, price will be greatly positively affected. I personally think that the bull run that will come post this halving will set records and surprise pundits to the upside. Keep in mind that I'm a layperson and not giving any financial advice. Enjoy the clip and stack sats.
I believe the ETF will be approved sometime around year end, whether it's in early January or December, sometime in that time frame. Okay. And I think that will pave the way for a very large influx of capital. I know you've had Eric on the show about Tunis, and he does this great work, right? I mean, there's 30 trillion with a T, 30 trillion. Remember, 1 trillion is $1 every second for 31,710 years. But 30 trillion is going to come into, or that's the total amount of money managed by RIAs and others that is not allowed at this point for whatever silly reason to own Bitcoin. And they can't own GBTC and they can't own Bitcoin miners, and they've called a timeout. Well, once there's an ETF, particularly if it's an ETF that BlackRock runs, there's going to be no excuse, and they're all going to have to approve it. Their clients have been asking for it. I would say I have a family harmony account at UBS. They won't let me own anything related to, like, why? It's my money.
Right.
You should let me buy what I want to buy. And they're like, no. So I think all that goes away. And I think Eric's number is, let's say 0.1% comes in. That's 30 billion. Well, but wait, 30 billion on 500 billion, that's not that much. Well, no, it's not 500 billion. 400 billion of the 500 billion of Bitcoin's market cap doesn't really trade. It's either locked up like the Satoshi wallet or the Winklevoss wallet, or hodlers that just said, take it out of my cold dead hands. It's only about 100 billion that is the free float, to borrow a TradFi term. And so 30 billion on 100, that'll move the price.
Yeah, for sure.
I don't think it's going to be 10 basis points. I think it's 1%. I think you have to do 1%. As a fiduciary, if you got, 50% in equities at some of the highest valuations in history, and you got, another 30% in bonds, which have had the first 2 negative years in the history of the bond market, 140 years of history, 2 negative years, looking pretty ugly. And you got this asset that is the best performing asset again, 11 of the 14 years that Bitcoin has been alive, it's been the best performing asset of all assets. It's the best performing asset again this year.
Yeah, Eric hit on his prediction about 150 billion in terms of market impact. Do you feel so you like that number, or you think that?
Well, I think he's 150 billion would be 0.5%, right? Instead of 10 basis points. And it looks like he's updated his thoughts. I'll go further and say 1% seems more likely. That'd be 300 billion. 300 billion on 100 billion of free float, price goes up a lot. And here's the interesting thing, Paul, is the way halvings work is the fair value increases. So we've got a tailwind that the fair value today, based on Metcalfe's law model that Tim Peterson runs and that I think is fantastic, says that the fair value is somewhere in the low 50s, 52, 53, let's just call it 50. So at the halving, fair value doubles. Well, what do you mean, Mark? What are you talking about? Well, think about it. The miners who secure the network, their costs are fixed, mining machines and electricity. So if their block rewards, the number of rewards that they're paid to secure the network, gets cut in half, and the price doesn't move, then they're out of business. So there's a built-in mechanism to move the price higher, which is actually really interesting because that attracts attention because there's movement. And so, long story short, fair value, every halving has added a zero. So we went from 100 to 1,000. Then we went from 1,000 to 10,000. Now we go from 10,000 to 100,000. So if fair value is 100,000 and we're trading at 26, it's a pretty rapid increase to fair value, I think, as investors buy things that are below fair value. But then what happens in the fall, post-halving, you get this parabolic blow off top. And in the previous cycle, fair value was around 30K. We got all the way to 69.
Right.
That was because there was too much leverage and too much gambling and speculating. I don't think we go 2x this time or 2.5x this time. Could we get 1.5x? Sure. That gives about 150K, something like that.
Yeah. Well, that is okay. So that's very intriguing. If you're estimating this could be in the $300 billion area,
maybe,
for based on just the exposure to these funds and obviously how that might play out. How do you think retail responds to this? Do you think retail is going to come in like a banshee coming in on this with a lot of now what would be legitimized ETFs? How do you think they play?
Again, I've been saying this for 5 years. My hashtag #GetOffZero is the wrong number, right? This is a truly unique diversifying asset that must be in everyone's portfolio. Okay? It doesn't have to be your whole portfolio. I never said that. It should be at least 1%. I'll argue 2 or 3%, but 1% is fine. And had you done that a decade ago, okay, had you taken 1%, half from stocks, half from bonds, 1%,
yeah, for sure,
put it in Bitcoin, your portfolio would have done two things. It would have compounded at about 250 basis points per year better with less volatility. Yeah, so it reduces risk and adds return. It's the perfect diversifying asset because it's 0.0 correlated to bonds and 0.15 correlated to stocks. And look, Markowitz won the Nobel Prize for a reason. CAPM works. When you add diversifying assets with reasonable levels of volatility or even high levels of volatility, if they're highly uncorrelated, your portfolio becomes more efficient. And so as a fiduciary, you can't not have this asset, particularly if now there's a ETF by a trusted brand.
Yeah.
So retail, many of them have abdicated that day-to-day responsibility to their financial advisor in a good way, right? Most people shouldn't manage their own money. I don't mean it's a bad thing. It's just that's not their specialty, right? They're nurses or construction workers or financial managers or whatever it is. That's not your day-to-day thing. And it didn't used to be that way, right? In the good old days, you worked for a company and you had a pension and they had a professional manager that took care of the money and you got a defined benefit for the rest of your life. And then they snookered us by saying, hey, we're going to change the rules and we're going to make it portable and defined contribution. Well, that was just a gift to corporations because they had to spend 30% less to fund their obligation, went straight to their bottom line and into the manager's pockets, and they thrust that responsibility on the individual. The average individual doesn't spend the time or have the knowledge to manage their portfolio. It's not a criticism, right? I'm not a great chef. I shouldn't try to cook my own food, right? I just, that's not my expertise.
Sure.
I should go take advantage of other people's expertise. I am a financial manager. I take care of people's assets. So I do think that the average investor will be very well served by having a good RIA, registered investment advisor, a good financial advisor who will say, I gotta put 1%.
Yeah, let's go that direction.
Again, that's not even a big number. If we got 2 or 3%, Katie bar the door.
Yeah, but that would be a different world for sure, especially in digital assets. Okay, so to your point of BlackRock possibly being kind of maybe the only horse in the race, you've got now. This is where it confuses me, Mark, because you've got Franklin Templeton now joining in on this spot Bitcoin. Yep. They came in this week. This is another heavyweight. You got Fidelity in the race. I mean, these are real players. Yeah. Surely there's going to be other angles here.
Yeah, and that's why I say I'm probably wrong that it will only be BlackRock. because how do you, with a straight face, approve BlackRock and not approve Franklin Templeton or Fidelity? Like, you could say, well, I don't want to approve Bitwise, or I don't want to approve 21 Shares because they're crypto people. They're not traditional people.
Yeah.
They probably understand, not probably, I know they understand this business better than the TradFi people. Not the TradFi people haven't hired good people and are smart. Actually, the Fidelity team understands as well as anybody, and they're amazing. The others, I don't know what kind of resources they have, but I know the quality at 21 Shares. I know the quality at Bitwise, high quality. So to not approve them and approve the Johnny-come-latelys who weren't there at the beginning, who weren't there on the pioneering phase, I think is just blatant corruptionism. The way, but look, we know that's how it works. I mean, think about all the people who've applied for ETFs. No one that I'm aware of, and I'm probably wrong, but no one that I'm aware of, other than BlackRock, has gotten 99.99% of their applications approved.